Hello and welcome to today's installment of our monthly wealth planning video series. Today's webinar is going to be focused on equity compensation, specifically turning that compensation into long-term wealth and some key planning considerations that everybody with a form of equity compensation should keep in mind related to any transactions that might impact that equity compensation. My name is Ryan Walker. I'm going to be your host today. I'm a certified financial planner and have been in the industry for about 15 years or so, and I put together a slide deck to review today to help our clients and future clients with some tidbits of information to take into consideration regarding any equity packages that they've been awarded either in the past or in the future as we look ahead. One thing to note before we kick things off today is that today's presentation is meant to be educational in nature. None of what I'm going to be sharing should be misconstrued as individualized investment or tax-related advice. You should always speak to your tax professional with any tax-specific recommendations, or schedule a meeting one-on-one with your financial planner or your wealth manager here at Stansberry Asset Management to evaluate your specific circumstances. But today, hopefully, we'll have a lot of foundational education and information that you can step away so that you can ask the right questions and be a little bit more well-informed about how to handle equity compensation in the future and to avoid any surprises or missteps. Also, I wanted to note that all of our webinars are recorded and posted on our website after the fact. You can find our historical webinars at stansberryam.com under the Insights tab. Just navigate to the On-Demand Webinars section for a list of the webinars that we have recently put together and recorded. Feel free to reach out to your wealth manager after the webinar with any specific questions that you might have regarding your equity compensation, as we certainly want to provide a good subset of information to understand truly what your equity package looks like now and in the future. So let's get things kicked off here today. Again, it's going to be pretty fast-paced, so buckle your seatbelt and get your notepad and pen handy to jot down some notes along the way. But I'll go ahead and load up our PowerPoint presentation and we'll get things kicked off here. So again, the title of our webinar today, it's Turning Equity Compensation into Long-Term Wealth and some key planning considerations that we should all be mindful of if we're awarded with equity compensation either in the past or going forward. Just to set some expectations, today's webinar is meant to help our clients and future clients turn complexity into an opportunity to minimize the likelihood of a large surprise or some unintended consequence related to equity compensation. What we've found that over the years, many folks, many investors who have equity compensation almost mentally treat it as a bonus rather than a core wealth driver. But equity compensation can certainly be a very valuable aspect of the total compensation plan when it comes to the overall net worth and financial picture of a specific client. My goal today is to help those who are participating make smarter equity compensation decisions and not just understand the high-level concepts, but really understand the impact of what those decisions may be from a tax and wealth building perspective. I want to frame the conversation today around long-term wealth building, not necessarily short-term timing related to equity compensation. Let's start by going through a quick rundown of today's agenda. We're going to be talking mostly about the differences between stock options and restricted stock units, or RSUs for short. Today we're not going to be covering employee stock ownership plans or employee stock purchase plans. However, if you're interested in learning more, if you're awarded those types of benefits, you should reach out to your wealth manager directly, and he or she will be able to go through the details of those specific plan offerings. But we wanted to keep today relatively fast-paced and cover just stock options and RSUs. We're going to be covering some of the tax basics and some of the common misconceptions related to the taxability of equity compensation. We want to also introduce some financial planning strategies that you might be able to use to improve long-term outcomes and think strategically about how to improve one's overall net worth while reducing risk as well, or company-specific concentration. So that's the agenda. We'll move on. But before we get into the meat and potatoes of the webinar content for today, just a quick background of our company overall. We are celebrating our 10th year anniversary this year in 2026. We were founded in 2016. I am pleased to announce that we are well above the $1 billion in asset under management value threshold. Most recently, we've crossed the $1.3 billion level. You can see some of the additional service offerings that we provide to clients. We have locations throughout the country, in New York, California. I'm beaming in from the Camas, Washington location up in the Pacific Northwest. And our headquarters based out of Westlake, Texas. At this time, we currently have 10 different investment strategies and launched alternative investment approaches back in 2023. Stansberry Asset Management provides holistic financial planning that does include tax planning as well as estate planning evaluation. And we generally serve individuals, families, institutions, and also business-related accounts too. So if you're interested in learning more and you're not currently a client, feel free to reach out to us after the webinar and we can dive into a little bit more detail about our overall service offerings. So with this slide, I really wanted to focus just for a few moments on providing background on why I believe understanding equity compensation really matters. First, equity compensation is primarily most common in tech, growth-oriented type firms, also startup companies. Both options and RSUs tend to be most common. So if you're in any of these sectors, it's possible, if not probable, that you're awarded equity compensation in one form or another. Over time, depending on how long you're with your particular organization, equity compensation can be an increasingly large and very important portion of total compensation, particularly if you're working with a successful company. Successful companies with a high degree of growth that may be going through an IPO in the future, or maybe they already are publicly traded and their stock price is performing particularly well. This equity compensation can be an increasingly large percentage of your overall net worth. Also, many employees tend to not fully understand the complex rules or tax implications behind stock options or restricted stock units. So we'll be covering some of those components today as we go through the webinar. So here I wanted to cover why companies tend to offer equity compensation to begin with. And essentially what it does is transfer some of the risk from the company onto the employee, and it gives the employee a bit of skin in the game in terms of that company's future success. It helps align employees with the company growth, and it rewards long-term commitment and loyalty to that particular company that's offering the compensation. At the same token, it does offer the company that provides the equity compensation with some benefits too, like preserving cash for operations and growth while offering some upside to employees. The term equity compensation just means non-cash compensation that gives employees ownership or rights tied to that company's specific stock. So I thought that I'd cover that to kick things off here, why companies tend to offer equity rather than just cash compensation. So I'd like to cover some key important terms here today. You can see 6 different important terms on your screen here, and we'll cover each one of them in a little bit more detail. All these terms drive decisions later on, so it's really imperative to understand the true meaning of each of these terms, as most of the confusion and missteps that happen related to equity compensation have to do with the misunderstanding of these basic key terms. So first off, the grant date. This is the date that the equity is actually awarded to the employee. The vesting period, it can range, and we'll explain in a little bit more detail about what this means, but it's when the ownership of the equity is actually the employees and not the employers or the company. The word cliff refers to a period before any shares become vested or owned by the employee. The fair market value would be the current value of the stock in question. The strike price is the price that the employee can buy shares at. It's the option to buy shares at the strike price, not the obligation. And then trading window refers to the period of time of when you're actually allowed to sell shares. Most commonly around earnings season, when a company is going through quarterly earnings season, especially if it's a publicly traded company, there is a restricted trading window when blackout period when employees cannot sell their stock options or RSUs. So we'll get into some of these categories in a little bit more detail, but I thought that would lay the groundwork as we move ahead. So let's dive into a little bit more detail about the term vesting, which, as we covered on the previous slide, just simply means when the employee becomes the owner of the shares that were awarded from the employer. The vesting schedule typically happens on a gradual time frame where there's a larger 1-year cliff vesting schedule and then a gradual 4-year vesting schedule where a smaller percentage of your awarded stock becomes owned by you, owned by the employee. Vesting is typically what triggers tax treatment as well, because that's when ownership is actually transferred from the company to the employee. So it's certainly good to understand the vesting schedule related to company stock to understand what the tax ramifications of that vesting schedule might look like for the employee on an individualized basis. One thing to point out related to vesting is that if you leave the company early, oftentimes you're going to give up the rights to the unvested shares. So even if you were granted a certain amount, that grant amount doesn't become fully owned by the employee until the vesting schedule has completely matured, which again is typically after a 4-year period. This schedule helps encourage loyalty to the firm and continued high performance in order to be awarded with more and more equity as time goes on. Vesting also, it drives the ownership, and the main takeaway is that it also drives the tax strategy and not being surprised with a taxable event as you go through the vesting period and window. So here there's 2 main buckets when it comes to equity compensation that we're going to be covering today. The first bucket, stock options. There are 2 types of stock options. Incentive stock options, or ISOs, and then non-qualified stock options, or NSOs. We'll get into the details of the differences between those 2 in just a moment. But essentially, stock options give the owner the right, not the obligation, but the right to buy shares at a fixed price. That fixed price is also known as the strike price that we covered a couple slides ago. There's going to be a profit, of course, if the stock rises above the strike price. So let me give you an example. Say we have ABC stock, which we have stock options for at a strike price of $25 a share. So the employee has the right to buy ABC stock at $25 a share. If the stock is trading on the secondary market at $35 a share, That gives the holder of the stock options the right to buy at $25 a share and potentially sell the shares at the current market price of $35 a share. So that refers to the profit potential. There is a risk if the stock stays below the strike price, because essentially there wouldn't be any value in exercising your stock option. So in that same example of ABC stock, where you have the right to buy shares at $25 per share, that's the strike price. If the ABC stock never goes above $25 a share, there's no benefit to exercising those stock options. So they really only become lucrative if the underlying stock performs well and appreciates in value over time. On the other hand, restricted stock units, or RSUs, are company grants. No purchase of stock is required, and they're taxed as income when the shares actually vest. It's very common to see RSUs in pre-IPO companies, so pre-publicly traded companies, where it's an incentive to employees to help drive the company towards potentially IPOing in the future, and then those RSUs turning into publicly traded stock at some point in the future. So those are the core differences between stock options and RSUs. Each work differently. Both have advantages and disadvantages. But let's move on from here and cover some additional detail regarding those two categories of equity compensation. So here I want to walk you through the key differences between incentive stock options, ISOs, and non-qualified stock options, or NSOs, which I covered some of the basics on the previous slide. First, on the left side, ISOs are an employee-only option. So ISOs should never be granted to contractors or board of director members, just to employees. And there are differences in terms of taxes as well. So ISOs tend to be eligible for capital gains tax treatment rather than ordinary income, depending on the holding period, which is an advantage because capital gains tends to be at a lower tax rate versus ordinary income. And then on the right side, the non-qualified stock options, they tend to be more common, a little bit less complex. They can be given to contractors, to board of director members, and also to employees, but the taxes are usually going to be at higher rates, at ordinary income rates. And there's also less restrictive rules related to selling the stock in the future or exercising your stock options. But really the main takeaway is that the difference relates to taxes. ISOs typically taxed as a capital gain, where NSOs are typically taxed at ordinary income rates. So as I mentioned on the previous slide, ISOs and NSOs differ primarily because of the taxability of that. ISOs, there's possible capital gains treatment, again, depending on the holding period after exercise. And then NSOs are taxed as ordinary income at the time of exercise. I included a quick visual at the bottom of this slide just to walk through the typical life cycle of options. This would apply to both ISOs and NSOs. So first step would be companies granting or awarding stock to the employee. Then the vesting schedule would kick in, usually over that 4-year period, as I had mentioned, and that's, again, gradual as the employee continues to work for the employer. If the employee leaves the employer before the shares are fully vested, likely those shares are going to be forfeited, the portion that has not been vested yet. The next step in the life cycle would be to exercise the option, and that basically means to transfer your stock options into actual shares of stock, or to exercise at the strike price that I had mentioned before. And then the decision of whether to continue to hold that company's stock or to sell shares either fully or periodically over time if your goal is to try to mitigate some of the gains implications over multiple calendar years. So part of that decision would depend on your overall taxable income in a certain calendar year and whether or not you expect that to change over time. So now let's cover some of the basics related to taxes on restricted stock units. RSUs are taxed as ordinary income at the time of vesting. This tends to be a little bit of a surprise for most employees who have never had RSUs before, because there's no deposit in your bank account, in the form of traditional cash compensation, but a portion of that RSU compensation is going to become taxed at ordinary income rates. The company oftentimes, not always, but oftentimes withholds a portion of the shares that you've been awarded with to help cover taxes. Doesn't necessarily mean that all of the tax liability is going to be covered by that withholding, but it's definitely important to be mindful of whether or not your company withholds shares in order to cover some of the tax liability related to that vesting schedule. Once the stock is then sold, the gain or the loss is taxed as either income, ordinary traditional income, or at capital gains rates, depending on the holding period from the vesting date itself. If the shares are sold after a 1-year period, then the gain would qualify as a long-term capital gain or loss. And if it's sold prior to the 1-year period after the vesting date, and those shares are sold, then they're going to be taxed as ordinary income. Again, either a gain or potentially, hopefully not the case, but a loss. So the greatest single risk related to equity compensation over time is concentration risk, especially if you're a loyal employee and have worked for the same employer for a long period of time and have built up equity compensation over the years. Your job and investments are tied to just one company. So that concentration risk is something that we take extremely seriously here at SAM and is represented across the portfolio strategies that we manage. So how we manage portfolios here at SAM is to limit the concentration or exposure to any one company by maintaining a high level of diversification across all of our 10 investment strategies. So when the company that you're owning stock in is performing well, of course that's a huge benefit to your overall net worth. But the opposite can also be true. If there's downside risk associated with that one company, the impact on your net worth can be compounded and can really be dramatically negative if the company were to underperform going forward. Emotional bias plays a really strong role because of your direct impact on the company and your exposure to the inner workings of the particular company that you're awarded compensation from. It can influence you into holding the company for much longer, but we really need to do our best to remove that emotional bias, to not get caught up in the loyalty to our employer when it comes to that equity compensation, and think about it from a long-term financial planning perspective to try to mitigate that concentration risk. So what are the planning opportunities that we could consider? Number one, diversify over time depending on the level of concentration that you have in any one specific company. Diversifying doesn't necessarily just mean immediately selling all the shares that you're vested in. It means being mindful of the level of wealth that you have tied up into one company and being mindful of the tax and timing implications of liquidating your stock over time. It's very important to plan these exercises strategically and sometimes using a multiple year exit strategy to try to reduce your exposure over time and to mitigate the potential of jumping up into a higher tax bracket in a certain year or having a surprise tax bill that you weren't planning on, but because many of the shares might have been sold at a gain, that gain is going to be reported and become taxable in the year in which the shares were divested. And this can be coordinated with your financial plan. It's very important to let your wealth manager know if you have equity compensation and you need help evaluating the best diversification strategy over time. So don't hesitate, pick up the phone, email your wealth manager with some information related to either your stock options or RSUs, employee stock ownership plans, etc., and schedule some time to review that information in more detail to develop a long-term plan. So here let's cover some common mistakes as it relates to equity compensation. Number one, and I see this far too often, it's waiting too long to exercise your options. It's definitely important to be methodical about reviewing what your stock options are, the strike price, the potential tax ramifications, and a reasonable strategy to divest your concentration risk. That brings me to my second point here, holding too much company stock. So as the stock options grow in value, or as your RSUs may grow in value, a larger and larger percentage of your net worth is concentrated in one specific company. Being mindful of that level of concentration and then slowly reducing that over time are key in order to preserve and to maximize your likelihood of retirement and financial success. Lastly, it's ignoring the tax impact until you actually file your return. Oftentimes there's a surprise after RSUs are awarded or stock options are exercised. And there's a large tax bill that might be due in April of the following year. You may not have the liquidity at that time to write a large check. Also, the IRS may apply some underpayment penalties or interest on the amount that should have been paid throughout the year. So being mindful and on top of what the tax ramifications are in advance will minimize surprises and maximize the likelihood that you would have hopefully already covered your tax liability throughout the year. So bottom line, what are the key takeaways today? It's very important when it comes to equity compensation that you know what type of equity you own. Is it in ISO? Is it an RSU? What are the tax ramifications, the advantages and disadvantages, etc.? Understanding the vesting schedule, as that might have a direct impact on your tax liability in a given year. Also, planning for what the tax liability might be is a huge takeaway, something that you should be mindful of, especially if you have equity compensation that's being vested or stock options that are being exercised. And lastly, avoiding concentration risk, which I covered a few slides ago, minimizing the impact of any one company on your overall balance sheet and net worth. Small decisions today and understanding truly what you own and what type of equity you have can really lead to much higher likelihood of long-term success and really the sense of empowerment, knowing exactly what you own and what the ramifications may be if you complete a certain transaction, such as selling stock that might have been awarded through equity compensation. Okay, so next steps. The best steps that you can follow if you're a little bit foggy on any of the topics that we covered today would be to fully review your equity package. Understand, do you have RSUs, stock options, employee stock ownership plan, etc.? Understanding the tax ramifications, the vesting schedule, future awards that you might be given down the road. And then, of course, that turns into the tax implications so that there aren't any surprises in the future, and integrating that wealth into your overall financial plan. I highly recommend working with your wealth manager here at Stansberry Asset Management to organize your equity package, to fully understand the tax implications, and to include this equity compensation into your financial plan. Please know that we're here to support our clients and future clients with this type of organization. We understand that equity compensation can be very complex, so please do lean on us for assistance as you go through review and assessment of your equity compensation package. If you have any questions about today's webinar, feel free to type in your question and your wealth manager or representative from Stansberry will reach out to you to provide some more information and feedback. If you don't already follow us on social media, I highly encourage that you do so. We're on Instagram, Facebook, and on X, and post often. Oftentimes we post about our upcoming webinars and different types of educational series, both in-person and virtual, that we might be hosting throughout the country. And I would like to encourage you to reach out to us to schedule a complimentary review of your individualized situation for one-on-one guidance. Feel free to use the QR code on your screen to provide your contact information, and someone from Stansberry will reach out and follow up regarding your question or inquiry, and we'd be glad to host you for a one-on-one, more in-depth complimentary review of your situation. I do want to emphasize that each situation is unique, so some of the concepts that we discussed today, again, shouldn't be misconstrued as individualized investment advice or tax advice, so reach out to us for a one-on-one consultation for more specific recommendations. Lastly, I want to thank you again for joining us for today's webinar presentation on equity compensation. Thank you for the clients that have joined today who have entrusted us in managing their financial life. And if any of this information resonated with you and you want to learn more about SAM or about how we can support your equity compensation assessment, please feel free to reach out at any time. Thank you all for joining. We'll see you again next time. Take care.